Ladies and gentlemen, good day and welcome to the Utkarsh Small Finance Q2FY25 conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions at the end of today's presentation. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I will now hand the conference over to Mr. Renish Bhuva from ICICI Securities. Thank you, and over to you, sir.
Thank you, Sunil. Hi, good afternoon, everyone, and welcome to Utkarsh Small Finance Bank Q2FY25 earnings call. On behalf of ICICI Securities, I would like to thank Utkarsh management team for giving us the opportunity to host this call. Today, we have with us the entire top management team of Utkarsh, represented by Mr. Govind Singh, MD and CEO, Mr. Pramod Kumar Dubey, Executive Director, Mr. Sanjeev Kumar Pravinsimaria, CFO, Alok Pathak, Head Assets, Mr. Sanjay Sharda, Head Consumer Banking, Mr. Vivek Vishnoi, Head Finance, and Mr. Puneet Maheshwari, Strategy and Investor Relations Head. I will now hand over the call to Mr. Govind for his opening remarks, and then we'll open the floor for Q&A. Over to you, sir.
Yeah, thank you, Renish. Thank you everyone for taking out time to attend our Q2 FY25 earnings call. During the last quarter, operations and business environment was challenging, especially in micro banking segment. While on the positive side, we saw improvement in deposit growth, overall liquidity scenario, and non-micro banking businesses like MSME and housing continues to offer healthy growth potential. In terms of business performance, our deposits have grown at healthy rate of around 40% year-on-year and 7.3% quarter-on-quarter, largely in line with our plan. Deposit growth was led by growth in retail term deposits, which grew by 48% year-on-year and 9% quarter-on-quarter. Our CASA deposit ratio was 19.6% as on September 24 against 19% as on June 24, and CASA plus RTD ratio improved from 67.1% as on June 24 to 68.4% as on September 24. As regards microbanking sector, Q2 FY25 has been a challenging quarter for microfinance industry. The initial stress in collection efficiency and asset quality, which was caused by heat waves and operational limitations during general elections, aggravated further in Q2 FY25 on account of higher borrower level indebtedness, and stress accelerated further following tightening of credit norms post MFIN's guardrail advisory. We believe guardrail advisory is structurally positive step for the sector and significant positive of which will be there once the current stress alleviates. Guardrail norms gives much better control on overall indebtedness level of the borrower as well as multiple lender relationship of the borrower. Overall, our gross loan book has grown by around 28% year-on-year and 1.6% quarter-on-quarter. Our loan portfolio growth during the quarter was impacted primarily by degrowth in JLG loan portfolio by 5.1% quarter-on-quarter, while non-micro banking loan portfolio has grown by around 10.8% quarter-on-quarter and 47% year-on-year. Growth in non-micro banking portfolio was in line with our expectation. We expect JLG disbursement to normalize from Q4 FY25 and basis which for the full year JLG portfolio could remain flat against FY24. While non-micro banking portfolio growth expected to remain largely in line with expectation of around 45 to 50% year-on-year growth. Overall, on account of our expectation of largely flat JLG portfolio in FY25, we expect our loan portfolio growth to remain around 18 to 20% for FY25 against earlier guidance of around 30%. From a medium-term perspective, we expect JLG loan portfolio to normalize for FY26 and expect it to grow by around 14 to 15% year-on-year and overall loan book growth for the bank in the range of 25 to 30%. In line with our plan, we have been inching up our disbursement yield, which improved by 80 basis points year-on-year for MSME lending, by around 50 basis points year-on-year for housing loans, and by 30 basis points for C and CV as well. We will continue to work towards building these secured businesses and optimizing lending yields further. In line with our strategy, share of secured loans in our portfolio has been increasing. It increased further from 34% as on March 24 to 38% as on September 24. We have set up dedicated teams for each of the non-micro banking businesses like MSME, Microlab, housing and other businesses, experienced business teams as well as credit operations, collections. We have large number of existing branches to cater to these products, and our current scale is relatively small in each of these businesses. This gives us confidence that we can maintain strong growth in these businesses over medium term considering our current scale. From asset quality perspective, we saw significant stress in operating environment in JLG business, because of which our collection efficiency declined from 96.2% in Q1 FY25 to 92.3% in Q2 FY25. Key factors which impacted collection efficiency and asset quality in microbanking segment included over-indebted level of the borrower, dilation in center meeting discipline post-COVID, external disruptions like Karja Mukti Abhiyan in UP and Jharkhand, floods in few districts in Bihar. In addition, restricted credit supply in JLG's lending segment following MFIN guardrail advisory and slowdown in disbursement by various entities following focus shifting on collection efficiency led to acceleration of default. As such, operating environment and collection efficiency trends in our key states, namely Bihar and Uttar Pradesh, remain largely in line with our overall portfolio. We are constantly working towards improvement in collection efficiency and asset quality. We have deployed senior field staff on critically identified branches. In addition, we have created a task force to handle collections from 30 plus buckets. This team comprises trained and experienced staff from microbanking branches and work primarily on critically identified branches. We are also focusing on improving critical processes like center meeting discipline. It should start on time, conducted as per the process to bring complete discipline back. In addition, we have increased manpower in microbanking business to reduce caseload per credit officer. Additionally, on an ongoing basis, we continue to split our large MB branches to maintain better control. Operating environment and delinquency trends remain weaker even in month of October 24, and currently we expect it to peak out towards the end of Q3 FY25 and reversal to start from Q4 FY25. Asset quality in secured loan segment, that is MSME and housing, has been under control. Overall, primarily on account of weakness in JLG lending segment, our gross NPAs increased from 2.78% as on June 24 to 3.88% as on September 24. In near term, our primary focus areas include bring center meeting and other discipline back in JLG lending and improve on our customer connect and overall improvement in collection efficiency and asset quality of JLG portfolio. Further optimization of disbursement yields and profitability in non-microbanking portfolio. We have set up systems, processes and people and are well placed for healthy growth in non-microbanking businesses as well. Building a more granular liability franchise and further improve on CASA plus RTD deposits. As on September 30, 2024, we had surplus liquidity of more than 1800 crore, which is higher than our usual liquidity requirement. Our CD ratio was 93% as on September 30, 2024, declined from 93.7% as on March 31, 2024. And if we net off refinance borrowing from advances, CD ratio declines to 85.7%. We don't have any short-term borrowings on our balance sheet. We expect our CD ratio to decline further in FY25. We continue to build our banking franchise and opened 51 new branches in Q2 FY25, taking total branch network to 967 branches as on September 24. Our profitability during the quarter was impacted by stress in collection efficiency and asset quality in JLG loan segment. On account of current challenges in microbanking lending for both asset quality and disbursement, we are also revising our guidance for FY25. Our revised guidance for FY25 deposit growth remain healthy and no change in guidance on growth as well as our plan on reducing CD ratio. Loan book growth of around 18 to 20% for FY25 against 30% earlier as JLG loan portfolio is expected to remain flat this year. We will continue to increase share of secured loans in our portfolio in line with our plan. Credit cost of 3.5 to 4.5% against earlier guidance of 2%. ROA of around 1% and ROE of around 7% for FY25. Now I'll hand over call to Sergio, our CFO, for taking you through financial performance for the quarter.
Thank you, Govindji, and friends, welcome to this bank's earning call for Q2FY25. As Govindji highlighted, Q2FY25 has been a challenging quarter for microfinance sector. This has impacted the bank's performance at multiple levels. First being the JLG disbursement has been lower, and it impacted collection efficiency and asset quality for JLG portfolio. This being on the negative side, I would also want to highlight the positive side. One that has been already alluded by Govind sir is we continue to build on with respect to our strategies of building secured loan portfolio, improving our disbursement yields, and also healthy growth in liability franchises. We have seen not only the deposit growth growing by 40% YOY, but the internal composition is also showing the mix and the traction that we desire. Now, again, coming back to the results, starting from the top line, bank's net interest income grew by 31% YOY to 1,131 crore for H1 FY25, and it grew by 26% YOY to 558 crore for Q2 FY25. Now, on the NIM front, the NIM was 9.1% for H1 FY25, which is similar to the NIMs of H1 FY24. However, NIMs during Q2 FY25 was 8.8%. The primary reason behind the dip in the NIM for the quarter 2 FY25 has been elevated NPAs slippages. There are two impacts. One is the requirement of higher provision, and also the accrual of interest gets reversed for the fresh slippages, and the disbursements were lower, which is the reason for a low NIM for Q2 FY25. We raised Tier 2 capital in quarter 1, which completed the fundraise on June 28. This Tier 2 capital had two objectives. One, to supplement the CRAR ratio, and this also helps us in our ALM for moving to secured book. It's a long-term locked 7-year borrowing, and with this raise, our cost of funds increased marginally to 8.2% in Q2 FY25. If I exclude, the IBPC from the working, and then the cost is lower by 10 bps at 8.1% for Q2 FY25. Other income increased by 5% YOY to 207 crore in H1 FY25, while it was lower by 2% YOY Q2 FY25. The primary reason for lower other income was PLC income, which was lower in this quarter compared to the last quarter. Primarily, this is the effect of demand, supply, and the premium correlation. Coming to operating expenses was 751 crore for H1 FY25, increased by 25% YOY, and it was 384 crore for Q2 FY25, increased by 24% YOY. We have been maintaining our investment in infrastructure in terms of creating branches, headcount, technology. These are in line. When you compare this and embedded it in the cost-to-income ratio, our cost-to-income ratio is 56.1% for H1 FY25, albeit 58.2% for Q2 FY25. One of the primary reasons of cost-to-income ratio a bit higher is the cost may be in line, but the income, the NIM has come down by virtue of the GLG stress that we have seen on the income and in the slippages. Coming back to the line which is, before the credit provisioning, the pre-POP, which is pre-provisioning operating profit, actually has increased by 28% YOY to 588 crores in H1 FY25, and by 16% YOY to 276 crores for Q2 FY25. Now, the line which is the most important line, which has set the tone for the GLG sector weakness, environment challenges, and due to the weakness in JLG, the credit provision increased to 333 crore for H1 FY25 and 208 crore for Q2 FY25. Primarily, this converted into ratio. Credit cost was 3.5% for H1 FY25 and 4.3% for Q2 FY25. This includes 40 basis point of discretionary floating provision, and if I were to exclude floating provision, my credit cost reduces to 3.1% for H1 FY25 and 3.9% to Q2 FY25. We expect that given the guardrail effect will come sooner than later, but till the time it gives a positive effect, the stress in the JLG portfolio will continue, and therefore our guidance, as mentioned by Govindji, for credit cost is now 3.5 and range of 3.5 to 4.5% for FY25. Friends, I just mentioned about floating provision. One important decision that I want to share. Our floating provision accumulated number is 190 crore as on September 30, 2024, which comprises of 173 crore specifically created for unexpected stress in the micro banking portfolio, and 17 crore is towards our and above floating provision on standard assets. Now, the thought process behind building floating provision was to build this provision in good times, and this can be used during the stress time. Considering the difficult stress environment and consequential higher NPA provision, the management and the board has decided not to create additional floating provision for only JLG loan portfolio beginning October 1, 2024, while we will continue to create floating provision, which is 20% of the standard provision for the period. In addition, we are also looking to seek RBI approval to utilize existing floating provision for JLG portfolio of 173 crore in full or in part. However, considering that the floating provision requires RBI approval, we have not factored this in our guidance for FY25. We hope to get this approval, and if we get, our credit cost will be lower than what we have stated in our guidance. Our net NPAs was 0.89% as on September 30, 2024 versus 0.26% on June 2024. The provision coverage ratio, since the floating provision is embedded in September results, the provision coverage ratio including floating provision was 78% as on September 24. Our profit after tax reduced by 15% YOY at 189 crores in H1 FY25 versus 220 crores in previous H1 FY24. Our returns obviously got impacted by virtue of the profitability numbers. Return on assets and return on equity was 1.5% and 12.3% respectively during H1 FY25. And during Q2, it was ROA was 0.8% and ROE was 6.6%. On the capital adequacy ratio, we are comfortable at 22.43%. Within that, Tier 1 capital is 19.85% as on September 30, 2024. As we mentioned, while the abbreviations in terms of the guardrail and the leverage systematic risk that has emerged, we already were in the move to factor of moving, more to the secured book. This was in our plan for the coming years, and therefore, at a point in time when we were 90% micro banking heavy, we are today at 57%, which is the trajectory, and that is what is going to continue. The business model is resilient in the sense to absorb intermediary shocks. I guess with this, probably we can take question and answers. One more point is on the reverse merger. We have already filed reverse merger applications formally to the stock exchanges and RBI. We are in dialogue with them. I guess we are hoping to hear from them on a positive note closure maybe early next quarter, which will enable us to file the NCLT application, say somewhere in mid of next quarter, Q4, which then, if I take 6 months, we are in line with the time frame that we had thought to see within 12 to 15 months by end of Q2 or early Q3 to get this transaction consummated as far as the reverse merging of the holding company into the bank is concerned. Thank you for taking this time out. Look forward to answer your Q&A.
Thank you so much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and then one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and then two. Participants are requested to use only handsets while asking a question. The first question is from the line of Vatsal Shah from Knightstone Capital. Please go ahead.
Yeah, hi. Thank you for the opportunity. Firstly, on the MFI space, what will be our 4+ lender book?
Yeah, in terms of number of customers, it will be about 14%.
14%. And this will be at the time of disbursement or as on Q2?
This is as on September.
As on September. Okay, thank you. And
Disbursement, it will be much lower, but this is as on September.
okay, got it. And if you can give the collection efficiency for UP and Bihar individually, if that's available.
So our collection efficiency for the bank as a whole was 92.3. Both UP and Bihar, as Govind sir also highlighted, was very close to this number only. Bihar is marginally better than overall and UP is marginally lower. So it's very close to overall number. Got it.
And my last question is on the SMA numbers. So the 4.4% SMA 1 and 2, this is for the overall book, right?
That's correct.
So generally, what percentage of this flows into NPA?
No, it depends actually. Situation to situation also. So in typical stress time, the flow forward from SMA 2 could be higher. In a normal time, the flow forward would be lower. And that is what we have seen. And it also depends, let's say, from which stress this SMA number is coming from. So in situations like current, flow may be a little higher. But, as situation normalize, flows actually comes down.
Yeah, I got that. But like an average, what is the number like 40%, 50%, just to get an idea of the slippages which could be coming our way?
No, I mean, I would like to answer that question through the credit cost because as I said, the flow forward kind of keeps changing depending on one, let's say, the time as well as underlying stress. So that is what, we have given in our guidance. So credit cost guidance, we are giving 3.5 to 4.5. So to some extent, actually, we are expecting a little higher slippages in quarter 3. That is what reflecting in our guidance as well.
Okay, got it. Yeah, that's it. Thank you.
Thank you. The next question is from the line of Sagar Tanna from Alchemy Ventures. Please go ahead.
Sir, a couple of questions. What is the NIM on our MFI book and non-MFI book? Or what are the yields? If not the NIMs, what are the yields on our MFI and non-MFI book?
So MFI, if you see, from our disbursement perspective, we charge between 23 to 25%. And on an average, on a portfolio basis, we are about 22.5 to 23% because there is dilution on account NPA as well. It's typically MFI. Non-MFI ranges between, on an overall basis, 12 to 30%.
20%, is that correct?
12 to 30, right?
12 to 30, okay. Got it. Right. Sir, and the floating provisions created up to March 24 and in the current financial year, totaling amounts to what percentage of our outstanding book?
So if you see, we have 190 crore, 173 crore is specifically for a microfinance business and additional 17 crore. And if we take a microfinance book of about 10,000 crore, specifically JLG book, it is about 1.7%.
So this is what we would have created in this current financial year, right? And what about legacy floating provision?
So this 190 crore is cumulative. This year we have created about 40 odd crore, which is 2%.
Got it. And just one last clarification, sir. You mentioned on the reverse merger timeline of Q2, Q3 by next financial year, FY26. Is that correct?
That is right.
Got it.
For continuation of the entire reverse merger process.
Got it. And that would lead to what percentage of equity dilution?
So, no, I guess this is a complete reverse merger of, the holding company, which is currently holding 69%. So that is the entire lot will become listed in that sense. So we have a 30% public, which will become 100% public now.
I got that part, sir. But would it lead to any equity dilution because of the merger, reverse merger?
No, it would not lead to any dilution. I mean, if you see the swap ratio which we have given, so in fact, there will be a marginal benefit to the existing shareholder of the bank with respect to the shareholding percentage. So there is no dilution. The number of shares for the bank as a whole will come down.
Sure. Thank you so much.
Thank you. Participants who have a question may press star and one now. I repeat, participants who have a question may press star and one now. The next question is from the line of Aryan Shah from IIFL Securities. Please go ahead.
Hello. Hi, thank you for the opportunity. Can you please help me with the lender 4 plus % of portfolio as a % of portfolio?
Yeah, so we had given this is about 14%.
No, that is the number of customers, right? I want as a % of loan outstanding.
Loan portfolio I don't have readily available. Maybe we'll come back to it.
Okay. Thank you.
Thank you. The next question is from the line of Ashlesh Sonje from Kotak Securities. Please go ahead.
Hi team, good evening. A few questions from my side. Firstly, can you talk qualitatively about how is the current bucket collection efficiency in the month of October, whether it has deteriorated versus September, improved or remained flat? Just the current bucket part.
So thanks, Ashlesh. I think it has not improved, I'll say, and maybe it has slightly gone down only, and that's why I mentioned that this October and till now it is either in the same range or it is lower than that, and so that's why I mentioned that the improvement should start from next quarter only. We don't expect much improvement in this quarter, so it's almost in the same range what it was in the month of September.
Perfect. Sir, and on a state-wise basis, can you comment, give us a bit more details on what are the challenges that your loan officers are facing on the ground? You highlighted a few things around over-indebtedness and Karza Mukti, but because if I look at the slippage numbers, they seem to be a bit on the higher side. So if you can just comment around it, why the slippage numbers seem to be higher than others, and also if you can give out the breakup of slippages across segments.
No, across segments, or we are talking across states?
Yeah. So slippages I can give you a slash. So total slippages is about 356 crore, of which about 300 crore is micro banking, and balance 55 crore is a non-micro banking.
And just commentary on the collections across states. What are the challenges that you are facing?
No, actually the challenge remains the same, that because of the recent guardrails by MFIN, I think there are a lot of customers who become ineligible for any fresh loans. So that is causing stress, and we are seeing some of the pockets, especially in some of the pockets in Bihar, Uttar Pradesh, some pockets in Odisha and Jharkhand, where we are having, you can say, little bigger challenges than other pockets. So we are finding little, for example, the Maharashtra is better than all these places. Though we have a small portfolio in Vidarbha and Maharashtra, but there it is a little better than the other places what we have seen so far. And largely because one is that 4+ lenders are there, and everyone in the industry, the banks, the small finance bank, NBFC, MFI, all have stopped lending to these people. So there is a stress built up right now, and that is causing challenge. Typically what happens, because normally we all go for collection through center meetings. Now if there are some, around 10-12% customers who are in various buckets who have not paid, then sometimes you have to go for door-to-door collections, which is really time consuming. So that is causing more stress, I'll put it this way. So gradually we are seeing that those customers are getting weeded out, and that's I'm confident that next 1 to 2 months time we'll see that the situation will improve from here in terms of the customer who are eligible, they will come forward and they will there will not new slippages because of this reason. So that is what we are facing or what we are seeing. In some pockets we have seen things like Karza Mukti Andolan, like Gorakhpur and that area, a few pockets in Jharkhand also. And incidentally this time we have got a good support from the administration and even police authorities also. and they are not able to take this forward. But sometimes temporarily for a week or for 10 days, this certainly impacts. But it has not a impact beyond that.
Thank you, sir. And just lastly, any update on equity capital raising plans?
So right now we are not in the process of raising any equity. I mean, we are in terms of capital adequacy, we are quite comfortable, and certainly I mean, we at least for this year we may not require any Tier 1 equity.
Perfect, sir. Those are all the questions I had. Thanks a lot and good luck.
Thanks, Ajay. Thank you.
Thank you. The next question is from the line of Sonal Minhas from Prescient Capital. Please go ahead.
Hi, sir. Am I audible?
Yeah, you're audible. Please go ahead.
So I wanted to understand the vintage of your MFI customers, basically the GLG customers. So we have 100 customers. What would be the vintage of customers who've been with you for more than 3 years or more than 5 years? Any slicing on that sort that you've done? If you could share some data.
So we can give you a cycle-wise data, loan cycle-wise. So about 26% of customers are in first cycle. Second cycle and third cycle are again close to 20% each, and balance is 4 and 4 plus.
So you said 23% are in the first cycle.
26% is first cycle. Second and third cycle each is close to 20%, and balance is 4 and 4 plus.
Got it. Okay. And sir, I just wanted to understand your recognition bucket. If you could explain that vis-a-vis the industry, at what levels of DPD you provide for what, that will just help understand how conservative you are in terms of your bookkeeping. If you could help that. Hello? Hello?
Yeah, can you come again, please?
Sir, I wanted to understand your recognition buckets for the basis on DPD, like at 0 to 30 DPD, what do you provide for? At 30 to 60 DPD, what do you provide for? When do you write off a loan? What are these vis-a-vis the peer set in the industry? If you could explain that, that will help.
Yeah. So for provisioning, we are following for all unsecured loans. So we start with 40% provisioning on the 91st day itself. And then every quarter...
Could you be a bit louder? Sorry, your voice is echoing here.
So for all unsecured loans, we start with 40% provisioning the moment it is crossing 90 days. So start from 40%, and then every quarter it will get added 15% each. So within 12 months, we provide 100%.
Okay, so 100% is provided at 360 days, basically.
Correct. So it starts with 40% on 91st day when it becomes NPA.
Got it. And between 30 and 90 days, are you seeing collection improve significantly based on customer behavior, or that's something which also is pretty close to what the bucket post of 90 days is?
So typically for JLG, the normal course, it used to be quick turnaround. We used to get a higher collection, but because of last 2-3 months when we had post this guardrails have been put by because we are the stressed customer around 12-13% for the industry level also. There, I think we are finding the slippage is more and recovery from slippage is less, in fact, and that is why we just mentioned that.
My question is generic, sir. Like, do customers pay after 60 days to you? Behaviorally, I'm trying to understand. Or typically, it is easier to assume that after 90 days, most of these loans slip up to be kind of write-offs.
So if you see historical data, we have seen even a collection from a written off account. So as Alok sir was saying, let's say even if we have provided 100%, post the account has become NPA, after a year we have provided 100%, and after that point we have written off as well. But historically we have seen even more than 10% collection from a written off pool, And NPAs also we have seen reasonably good collection, but typically, it also depends on time to time and stress to stress point. So typically, when there is a very high stress time, the entire focus will go on collections from softer buckets and from regular clients. The moment stress alleviates, actually your focus moves on collecting from a harder bucket clients as well. So in normal time, we see good collections from NPAs as well.
Okay. So my question is that, let's say if 10 accounts slip after 60 DPD, and out of those, you are saying that so 10 accounts slip after 60 DPD. How many of those accounts actually reach, let's say, 360-degree DPD cycle? All of them, or very few of them?
No, alternatively, what I can tell you is roughly, let's say, whatever accounts slip to NPA, typically in past we have seen recovery of about 25-30% from that pool as well. And as I said, little more than 10% from a write-off pool.
Got it. Okay. Understand that. I'll just fall back in the queue. I have more questions.
Thank you. No problem.
Sure.
Thank you. The next question is from the line of Pritesh Bum. Please go ahead.
Hi, good evening, team. Just a couple of questions. Just wanted to check how many, so if you can give a data point, how many number of accounts are falling in overdue, and how is that panning out across months?
Pritesh, we have given the portfolio breakup, the DPD breakup of our micro banking portfolio in terms of amount. Are you looking for number of clients?
Yeah, so I'm just looking for a forward flow, how much number of accounts are falling into overdue each of the month. So just trying to see if that has come down or is moving up.
Okay, so I can tell you two things. One is Govind sir covered in his opening remarks as well, that overall operating environment remained difficult in October and so basically the flow rates remain there. And secondly, instead of flow forward rate, what we have put in is the guidance on a credit cost for full financial year 25. We've given a guidance of 3.5 to 4.5%. So, and our credit cost in H1 was about 3.5%.
Got it. So just coming to that credit cost part which you mentioned, so 3.5% or maybe it will be more from microfinance. So right now already 300 crores slippages, which means 6% of the book. And given that write-off policy is there at about 210 DPD, we do 100%. So it seems that the 3.5 also will be breached because that credit cost will maximum going to MFI. So any views on that?
So if I just split this 3.5 also, it was about 5% for microfinance and about, as we have been guiding in past as well, 1 to 1.2% for non-micro banking.
Correct.
Yeah. So for
seems to be that it will breach because your write-off this quarter also is quite low. Seems to be when you will be doing write-off, and that will put pressure on your PCR, and that's why you'll have to do a higher credit cost.
That may be the case. I think a lot of intervention that mentioned by Govindji in terms of how we're going to tackle to see that we remain within the range of 3.5 to 4.5 is going to be the essence. Notwithstanding, I guess if the environment further gets stressed, it's a different outcome. But keeping into account the way the ground level force, I guess we should be on an overall basis within the 4.5 upper cap of the stress or credit cost that we have just given guidance to.
Got it. So two more questions. One is how much is new to bank in MFI this quarter, and will it be sole banking? Will it be only Utkarsh?
So on an overall basis, we have about 32% which are unique to Utkarsh. The new customer acquisition is not a focus right now. So new to credit customers, anyway, we are not acquiring too much because the focus is completely on collection. And on a book basis, we have about 32% clients which are unique to us.
Got it. And how much is the collection team number? If you can give the number, that will be great.
So both credit officer and a collection team put together, we are close to about 6,500 people.
And only collection?
Only collection.
So typically the way it happens, collection is done. I mean, the people who source the customer, they also do the collection part. So now, when you say hardware collection, we have around 500 plus, around 1,000 people who are dedicated for collection. Obviously, they support the branch staff also. So that is a team. Otherwise, entire team is for collections only. As Puneet mentioned, right now there is no focus on acquiring new customer or acquiring your disbursement the way it used to be. So entire team of, in fact, not only 6,500 loan officers, but we'll have close to 2,500 people who are the supervisors, the branch managers, the branch operations manager, the area managers, division managers. The entire team is working on the collection part right now. So some people will be dedicated for the hard collection, otherwise entire team is working on that.
Got it, sir. Thank you for those answers. Thank you. All the best.
Thank you. Pleasure.
Thank you. The next question is from the line of Swaroop BV, a retail investor. Please go ahead.
Hi, sir. Sir, when we look at the over-leveraging problem, at the ground level, many of them have taken, like 4+ leveraging has happened from cooperative societies and unorganized Section 8 companies. So will they be also included in MFIN guardrails further, sir?
So as far as guardrail is concerned, we normally go by the credit bureau wherever there is and it's now it is family level. Earlier it used to be individual level, now it is family level. So if there is any type of credit history with the credit bureau of the entire family, then it comes into play. I'm not sure about the credit society whether they actually report to credit bureau or not. Having said so, I want to mention only one thing, that in the core geography of Utkarsh, where we are talking about Uttar Pradesh, Bihar, Jharkhand, there are not many credit societies in that area. But I'm not saying that, I don't have the exact number right now, but there are not many. And I'm not sure about whether credit bureau will submit the data or not.
But as per MFIN guardrails, sir, which is going to be followed further, will they be also covered or not, sir?
Very, very difficult for me to respond right now. I mean, at least I'm not aware of any such discussions or any plans right now.
Understood, sir. Thank you, sir.
Thank you. The next question is from the line of Vinay Nadkarni from Hathway Investments. Please go ahead.
Yeah, thank you. Just wanted to know a few things on the MF loans. Can you just spell out what are the disbursement yields and what are the portfolio yields of both joint liability group as well as MBBL?
So for JLG, we have our disbursement yield ranging from 23 to 25%, and for MBBL, it's 25%. And if you see weighted average, as I said earlier, it ranges between 22.5 to 23% on a portfolio basis.
Okay. And secondly, when we are looking at these joint liability groups, these are supposed to be a secured. I mean, instead of going individual, we used to go to joint liability because there was a more shared pool of assets, right? I mean, liability to pay would be more joint. Is that causing a problem when you are now going in individual, or how is it?
No, I mean, when we talk of microfinance or JLG loans, these are good loans only. The only challenge is when there is a stress in this system, and a lot of people who are especially 4+, they won't be able to honor the commitment. The others are also under stress right now because I think there is a issue of overall funds flow within the microfinance borrower. So currently, what we are seeing, in fact, in ground that the joint liability is operating or working for a few, you can say, few fortnights or few months only. Maybe 10 years back it used to for the entire period. That's why we also mentioned that one of the focus area for us to bring the discipline of center meeting again. So that discipline, one of the reasons why this stress is there, one of the reasons is that discipline is not the way it used to be earlier. And we are seeing when there are real stress, then after few installments, we are not finding that people are, contributing. Also, what is also happening, post-COVID, the center meeting, the conduct of center meeting is not that regular the way it used to happen earlier. In many of the cases, because of because of center meeting not happening properly, people are having door-to-door collections also. So maybe it's very difficult to say what is the number, but my sense is 70-80% cases center meetings are happening. Rest of the collections are happening through door-to-door, and that's why this challenge is there right now.
Okay, thank you. Tell me about the tenure of these loans, the micro loans. This will be what? Typically what tenure?
So these are, 14 months and 24 months loans. On a blended basis, around 17 months will be average, tenure of these loans for us.
Okay. And the loans that you have disbursed over the last 4 quarters, do you see any difference in terms of the response of payment? Or, I mean, I'm just trying to understand whether the problem that you're facing is a vintage problem, or is it also including the fresh disbursements?
No, see, ideally, the way we should look at is the disbursement pre and the post implementation of guardrail, and not really, let's say, 12 months before from now or otherwise. Because post guardrail, actually, there's a significant, stringent norms are kind of introduced. So maybe after a few months' time, we would see a clear differentiation in terms of performance of the pool, which is kind of originated post guardrail implementation and which is pre-guardrail implementation. Because otherwise also, if you see what happened in JLG, a large part of loan is actually subsequent cycle loan as well. So even if, let's say, it is a disbursement, a new disbursement, it is post, let's say, the customer has foreclosed or closed the earlier loan and customer is migrating to the subsequent cycle.
Okay. Thanks a lot. Thank you.
Thank you. The next question is from the line of Franklin Moraes from Equentis Wealth Advisors. Please go ahead.
Yeah, thanks for taking my question. So first I wanted to understand, the reasons that were mentioned in the past because of elections or floods or, whatever be it. Are those reasons still prevalent as of now, or most of the reasons are done with?
Our assessment is the regions which I mentioned, that was the region why there are slow collections in Q1. But the current regions or current, region is basically the guardrails put from 1st of August 2024, which restricts, you can say, on the industry level, you must have seen around 12, 13, 14% customers who are not eligible for any loan. So the cycle for those customers is a challenge right now. So currently, whenever we are talking to any clients or any of our people also, and even at the industry level, I think this is the reason for that. And that's why, I keep repeating that once we are able to come out of these 14, 15%, I mean, broadly, the range is that, the things should start moving, moving or should start improving from there. That is what we think. But currently, the prime reason is the guardrail where we can't give loans to these set of customers who are over indebted.
What would be the difference in, maybe collection efficiency or, NPA levels or delinquency levels between this 4+ and the others?
So our experience is that it is almost more than double, in fact, for this segment of customer who have taken 5 loans, 6 loans, 7 loans. I think there it is almost double. Puneet, you have checked it? Yeah.
Okay. And RBI also did come out with a netting of regulation sometime. So just wanted to understand, if we have to assess our customers or wherein we are giving another fresh loan before the culmination of or rather the entire repayment of the existing loan. So what percentage, maybe in terms of volume or value of our customers would fit that criteria?
So normally, I want to clarify, there is no guidelines from RBI so far on this part. Yes, obviously there were some discussions, the netting of should not happen. So, what was the second question? The percentage? No, but a regular customer will do that part.
I wanted to understand whether we do wait, for the entire loan, existing loan to get, repaid entirely before, giving out a fresh loan.
No, sometimes it does happen that customer doesn't wait for the entire period, and suppose 5, 6, 7 installments are still pending. They pay that installment and take the new loan. That also happens. They may not wait for the entire period of the 24 months. They will not wait. At the end of 18 months, 19 months, 20th month, they will come for the next cycle, and normally they get based on obviously their requirement, they will get a higher loan next time. So they don't wait for the last day. This typically happens in all the cases.
Okay. So safe to assume that for a 24-month loan, generally after 18-19 months, you would be giving out a fresh loan in most of the cases.
Obviously, customer, in fact, even 20% customers will drop out also. But I'm trying to say that this is the, this can also happen. They become eligible for a higher loan after they have completed for a certain period. And many of the customers avail that. So they will not wait for the last day.
Understood. Fair enough. Thank you.
Thank you. The next question is from the line of Rajiv Mehta from Yes Securities. Please go ahead.
Yeah. Hi, good evening. So my question is, till what level of PCR decline are we comfortable with? Because we've already applied to RBI for utilization of floating provision, which is already a part of our PCR. Then we will also have higher slippages coming in the next 2 quarters because we have a huge SME pool, which is about 1,000 crore in micro banking. Hence, how should we look at PCR? What level it can decline to by March? Or maybe what is built in, as a level by March in your credit cost guidance of 4 to 4.5%?
So we are at PCR as it stands today. We would want to see all in terms of the provisioning that is likely to happen. Anywhere between 65% is where we would like to be upwards. That will be the endeavor. This is excluding the floating provision.
Okay. And then one more question on, has there been any recent tweaks in lending rates in JLG or individual loans in micro banking in the recent months, or do we plan to do anything at all?
So we are evaluating that part also. We are yet to conclude that part, but we are evaluating that, whether there is a case for reviewing the rate of interest in JLG loans. Maybe we'll take our call very, very shortly.
Okay. Thank you, sir, so much, and best of luck.
First of May, actually, we had implemented differential pricing. So earlier we were lending at 25%. That point of time, we started lending from 23, 24, 25%, depending on the credit profile of the customer and the branch performance.
Sorry, earlier we were at flat 25 before this?
Yeah, so basically till April 24, we were at flat 25. From May, we started differential rate of interest, which is 23, 24, and 25. So for best of the profile customer, as well as if the branch performance is good, we could lend at 23%, or let's say 24%, else it was 25%. So
yeah. Okay. Got it. Thank you.
Thank you. The next question is from the line of Kushal Borlikar, an individual investor. Please go ahead.
Hi, thank you for taking the question. For the group loans portfolio, given the recent increase in delinquency and industry scenarios, have you taken any policy tightening or actions at the field level other than the MFIN guardrails?
No, certainly we have done, other than guardrails anyway implemented by all the players from 1st of August 2024. Besides this, we have done a lot of activity at the ground level. Besides the strengthening of collection part, as I mentioned, strengthening of the center meeting discipline. So I think the training of our people, I think we are doing those things also. And the most important part, if you really ask me, is the discipline part besides the over-indebtedness part. So we are working a lot with our staff and with our clients by policy and process implementation. So I think that is a renewed, I'll put it. It's not that it was not a process. It was a process, but I think it was not implemented with that rigor. Now it is being done, for sure, in terms of discipline part and in terms of the center meeting discipline part, and the discipline on the employee part also.
Sure. And is any of the group loans portfolio covered under any of the central government guarantee schemes?
No, not as of now.
Okay. Thank you.
Thank you. The next question is from the line of Aryan Shah from IIFL Securities. Please go ahead.
Sir, one clarification, whether this 4+ lenders which you spoke about of 14%, whether it includes Utkarsh?
Yeah, certainly.
It is including Utkarsh, right?
Yeah. Yes.
Okay. Thanks.
Thank you. We have a follow-up question from the line of Vatsal Shah from Knightstone Capital. Please go ahead.
Hi again. So just wanted to get an idea of X bucket collection efficiency, if you can give that, just to understand new flows into the SMA pool. Hello?
I think we don't have the number handy as we speak. We will, you can connect Puneet or Vivek, and we will let you know on that.
Yeah, sure. No worries. Okay. Thank you.
Thank you. So that was the last question. I would now like to hand the conference call to Mr. Govind from Utkarsh Small Finance Bank. Over to you, sir.
Yeah, thank you all the investors for coming on this call. And as we know that currently microfinance is one which is passing through a challenging phase. As far as the other businesses are concerned, we being a bank, the non-JLG book, the non-micro banking book, as well as the liability franchise is working very well. And we have taken a number of initiatives, to arrest or to improve the collection efficiency on the JLG part. When we do expect that in foreseeable future, in next few months, we should see a good improvement in overall JLG, or at least the pain whatever we are seeing should be over. That is what we expect. So thank you once again for joining this call, and then it's the entire ISEC team. Thank you very much for arranging this call. Thank you. Thanks a lot.
Thank you. On behalf of ICICI Securities and Utkarsh Small Finance Bank, that concludes this conference call. Thank you for joining us, and you will now disconnect your lines.